Welcome to The Explainer. Today, we're diving into a real financial head-scratcher. How can a company's revenue shoot through the roof while at the same time its profits just vanish? We're going to break down the numbers and uncover a classic story of high-stakes business growth.
Okay, so let's jump right into this puzzle from Ace Integrated Solutions. Their latest numbers show two totally opposite things happening at once. On one hand, you've got this huge 40% plus jump in the money they're making. But on the other hand, their profit didn't just get smaller, it completely flipped from a healthy gain into a loss.
So yeah, this is the big question we're tackling today. It sounds totally backwards, right? More sales should mean more money. But by digging into their income statement, checking out their different business segments, and looking at their overall financial health, we're going to solve this thing piece by piece.
All right, first up, let's just lay out the core of this mystery. This is where our investigation really starts, with these two key numbers that are heading in completely different directions.
And wow, you can see the split so clearly right here. Revenue from operations jumped from about 2.2 crore to over 3.1 crore. Now, if you're not familiar, a crore is 10 million rupees, so that's a really healthy sign of growth. But then look at the bottom line. A 24-lakh profit, that's 2.4 million rupees, has completely evaporated, turning into a 1 lakh loss. That's the puzzle we need to solve.
So, where in the world did all that new money go? To figure that out, we've got to follow the trail on the income statement. This is where we are going to find our first major clue.
Here it is, the problem in a nutshell. For this last quarter, the company's total income was 3.22 crore. But look at the expenses. They were just a tiny bit higher, at 3.25 crore. It's that tiny little gap that makes all the difference. That's what tipped the company from making a profit into taking a loss.
So let's be clear, this isn't a story about a business that's losing customers or failing. Not at all. The real story here isn't a lack of income, it's that the costs just went into overdrive and grew even faster than all that impressive new revenue.
And this is the smoking gun right here. I mean, look at this jump. Expenses didn't just creep up, they absolutely exploded, going from 1.88 crore all the way to 3.25 crores. That massive increase in costs completely swallowed up that great revenue growth we saw earlier.
You can really feel the whiplash here. We're not talking about a slightly smaller profit. This is a complete 180-degree turn from being comfortably in the black to being in the red.
Okay, so we've identified the villain of the story, runaway expenses. But why did they grow so fast? To solve this puzzle, we need to understand what Ace Integrated Solutions actually does for a living and which part of the business is driving all these changes. So this is what the company's business looks like now. It has three main parts. But look at that huge slice of the pie. Over half of all the money they made came from just one area, specialty chemicals. Definitely keep that name in mind. You know, that chart, it holds the real secret. Because when you compare this revenue mix to how things used to look, you find the one critical detail that explains pretty much everything. And there it is. Bingo! The company's biggest moneymaker this quarter, specialty chemicals. It's a brand new business for them. It wasn't even on the books in the earlier report. This one change explains it all, both the massive surge in revenue and the most likely source of all those new costs. I mean, think about it. Launching a whole new division from scratch, that costs a ton of money.
Okay, so a quarterly loss, that can sound pretty scary. It makes you ask, is this company in real trouble? To answer that, we need to zoom out. We need to look past this one quarter and check the company's overall financial foundation. And for that, we turn to the balance sheet.
The easiest way to think about a balance sheet is like a financial checkup for a company. It's a snapshot in time that tells us if its bones are strong or if there are cracks in the foundation. So on one side of the equation, you have everything the company owns, its assets. We're talking cash, equipment, you name it. And that comes to nearly 21 crore.
And then, on the other side, you have what it owes, its liabilities. And that's a much, much smaller number, just 1.7 crore. You always want to see a big, healthy gap like that between what a company owns and what it owes.
So what this tells us is that, hey, despite that one unprofitable quarter, the company's foundation is actually really solid. It's not drowning in debt. In fact, things have even been improved a little. This suggests they have the financial muscle to handle these kinds of short-term costs that come with a big expansion.
Okay, let's tie this all together. Let's recap the story we've just pieced together by following the clues in the data.
You see, it follows this really clear four-step path.
It's a classic business story of a company making a big, ambitious bet on growth, paying the price up front, but having the underlying strength to hopefully see it through. The puzzle is solved.
So, what you should really take away from all this is that one bad quarter on its own doesn't tell you the whole story. You have to look at the why. And for Ace, this looks a lot more like a textbook case of growing pains than a sign of actual failure. They're spending money to make money.
And that, of course, leaves us with the big, juicy question for the future. They've made their move. They've spent the money. But will it pay off? Can they make this new, bigger business profitable in the long run? Well, that's what makes following a company's journey so interesting.